Hello, this is Dean Kernut, and welcome to the Alpha Exchange, where we explore topics in financial markets associated with managing risk, generating return, and the deployment of capital in the alternative investment industry. It was a pleasure to welcome Kris Kumar, CIO of Goose Capital, to the Alpha Exchange. Our conversation starts with Fed policy and the manner in which the 500 basis points of policy tightening is impacting the economy. To this, Kris argues that the propitious starting position for both households and corporates in this cycle has been quite different than in previous ones, thus blunting the impact of rate hikes. He points as well to loose fiscal policy with the unemployment rate so low. For Kris, what happens next depends more on fiscal than monetary. We next consider the backdrop for valuations, starting with fixed income. Kris sees safety that comes from a coupon on twos that approaches 5%, noting that there are positive real yields generally in most of the world. From an earnings yield perspective, however, U.S. equities have zero premium to bond yields, and Kris points to the concentration of earnings growth coming from the top of the S&P, which in turn is a bet on generative AI. Should this growth not materialize, the lofty multiples currently awarded these stocks could be re-rated lower. Within equities, Kris makes the argument that we've invested a lot in bits but not in atoms, and going forward, investment dollars may move away from tech into areas associated with energy demand. How else to satisfy all of the incremental power to run all of the data centers built? We finish the discussion with an assessment of the price of vol. Kris points to the epically low level of implied correlation on the S&P, a result of the bifurcated market in which a small but valuable subset of the index is a bet on AI. He sees scope for the still elevated level of rate vol to come down, but upside in vol on commodities like copper as a function of all the spending on infrastructure that will ultimately come as a function of the AI boom. I hope you enjoyed this episode of the Alpha Exchange, my conversation with Kris Kumar. My guest today on the Alpha Exchange is Kris Kumar. He is the CIO of Goose Capital, an investment manager with a macro lens and creator of some ETFs catering to institutions and high net worth individuals. Kris, it is great to welcome you to the podcast today.
Thanks, Dean. Pleasure to join your podcast. A big fan. Excited to be here.
Listen, you and I have known each other for a bit, but have recently reconnected, and I'm very excited about that. You've got a lot of ideas and an interesting framework that I think balances some of the need for evaluating the here and now, but also really incorporates some longer term themes and thought process around where things are going over many years. So I'm very interested to explore some of your thought process around that. Let's get our conversation underway with just a little bit of your own background, some chronology in terms of your experience in the markets, how you got to be the CIO of Goose. So just take us through quickly your background, and then we'll pivot to just the broad elements of your macro framework.
So I started off on the foreign exchange derivative side. So I worked at Citibank and then later at Barclays, mostly foreign exchange derivatives. And towards the end of my stint at Barclays, as part of a proprietary trading team there. And then I spent about 10 years on the sell side, mostly focused on FX and front-end related things. And then in 2011, I decided that I wanted to do my own thing, started a small systematic firm that was doing systematic strategies. We got off to a great start, but if you remember, that was a time when the Fed and other central banks were doing a fair bit of easing, which meant that the interest rate volatility and FX volatility kind of collapsed. So the foreign exchange rates were not moving much. It wasn't the best of times for a strategy like that. But I was lucky to get introduced to some folks affiliated with Omega. Omega, as you know, was a large equity hedge fund. Lee Cooperman, the legendary equity investor. I was very lucky and fortunate to work for them for about 3 years. So I spent 3 years on the Omega macro team, managed a substantial amount of assets with a colleague of mine. After that, we left to go work at a firm called MKP. They're also a large credit macro hedge fund, very successful fund, been around for a long time. I spent about 2 years there. In late 2018, I decided that I had seen how some of the larger firms operated, and I wanted to be on my own. I started Goose Hollow 2.0. In this format, we initially started with a few large institutional clients. And then about 2 years ago, we decided that we also wanted to be in the public ETF space. We launched one ETF in 21, late 21, and then we subsequently launched a couple of other ETFs recently.
Fantastic. Well, I want to probe a little bit on the FX derivative side of things. I'll preview it by saying I was a young, hungry kid coming out of the University of Chicago in 1996, and I hit the Lehman Brothers equity derivatives desk. And so this was well before the dawn of electronic option trading and certainly zero DTE. They didn't even have weeklies back then. But during my time in business school, I got myself enmeshed in Risk Magazine, just looking at a lot of the option pricing pieces that were coming out, variations of Black-Scholes that were meant to solve for some bell and whistle associated with some option structure. And so I started suggesting these option trades on the derivatives desk, the equity derivatives desk, and they were like, there's not even close to the kind of liquidity you would need to trade these. But of course, in FX derivatives, things like double no touches and so forth really have been around and are kind of a legitimate part of the trading process. I'd love for you just to tell us just a little bit about FX derivatives and maybe some of the esoterica that it's made its way into the trading process for buy-side institutions.
There's a few things to think about. So the first one is FX is one of the few markets where it's a complete market, meaning you have Arrow DeBrue securities. So essentially what I mean by that is you have every possible strike at every possible point in time you could actually get an option price for, right? So in equities, let's say you want to trade the S&P. Now it's different. You almost have an expiry every day. But historically, like you had the monthlies and the quarterly expiries and the month ends. That was really where the most liquid point. But in FX, if you wanted to take a view on something 3 days from now, there is a market for it and somebody will make you a price in the major currencies. So in that sense, it's a very complete market. And it's a nice place to start because you imagine things that you want to do and you can go and price it and trade it. So that's a nice thing. But the flip side of FX is that if you think about foreign exchange is the result of some other transaction. Foreign exchange by itself, people think about it, and from time to time, it becomes super important. I think now is a good time to think about FX, but historically, you would have very long periods where nothing happens in foreign exchange. And the reason is, if the central banks are not diverging much, if they're all doing the same thing, then there is nothing to do in FX because central bank, it's a exchange rate is just the price that the central bank set. And so if they all decide to concur on things and don't do much, then nothing really happens. And you have some carry that drives flows, but really there's no big moves in FX. So what that means is for every 5 years, you get like some big move, some big trade, and everybody tries to make money when that happens. For the rest of the time, you have to deal with the carry and you have to deal with very small movements. So if you think about this yen move that's happened, the yen has gone from 120 to 160. If you go back in time in 2011 or 2010, the yen was at 80. So it's gone from 80 to 160. So you say, wow, that's a big move. But it's taken 13 years for that to happen. We know many stocks that have doubled this year. I mean, they're doubled in the last month. And if you take something like Meta went from $90 to $500 in a very short period of time. So what that means is in foreign exchange, in order to actually generate returns, some people just look at it as the residual, an equity trade or a bond trade they're doing. And it's just like, oh, do I want that risk or not? For other people, the FX becomes important because if you're in the FX market trying to make returns, you have to somehow leverage these small moves. And hence, I think you have fairly complex options traded in foreign exchange. I mean, I'm going further back in time. I think the glory days of FX was from 2001 to 2007, 2008, I would say, because we traded all kinds of crazy instruments that now people would say, how did you even risk manage this thing? Like, how did you even take into account all the things that could happen? So there was a period where there was a lot of excitement on complexity. But now I think the FX market has changed a little bit. There's still a lot of barriers and all these things that trade, but to the large extent, it's just first generation exotics. But what we mean by first generation exotics is digitals, which are essentially call spreads, put spreads, barriers, which are really a vanilla option with like a one touch attached to it, like an American style digital attached to it. And that's pretty much the majority of the FX market at this point. Of course, people trade double no touches and worst off knockouts. And we've traded every possible thing you can imagine. In fact, my craziest FX trade actually goes back to 2007. We had a client that wanted to trade an FX option on a credit event. So this was the time when, people were doing CDOs and CDO squares. I don't think they printed a CDO cube. I was actually going to patent the exponential CDO. As you know, if you do a Taylor expansion of exponential CDO, you have all the terms. So I said, okay, maybe I should patent this thing. That was the time. And so we actually traded this thing where it was actually it was a Canadian paper company, Habit TV. If that company were defaulted, there would be an FX option that came into life. And if it didn't default, then the FX option didn't exist. And we actually somehow managed to trade this thing. There was a time when all of that was going on. And now I think you still have a lot of complexity relative to other markets. Some of that is the need for leverage in foreign exchange. So if you want to make any returns in FX, let's take an example. Let's say we think that the yen is going to strengthen from here. The yen's trading at 155. It's going to go to 130 in a year's time. You're going to have to figure out a way to use some sort of option structure to ensure you're making any meaningful amount of money on this move. The actual move is like a 10% move or 15% move. It's not really meaningful. You have equities that move 5% in a day. So if you're going to be having this position for 2 years, you have to hope that you're going to make more than 15% on a move like that, on the risk you're taking. So I think there is definitely a need for derivatives in the FX space, particularly for investors. I mean, also like the other aspect of FX is that you have certain participants who are kind of balance sheet constrained. Think about a typical corporate. They need to hedge their foreign exchange, but they need somebody to give them a balance sheet so they can actually execute the hedge. And they can probably not spend much in premium. They won't get the accounting treatment for doing that. So there is like a fair bit of complexity that they can do, and that creates liquidity for the other side. Because if all the hedge funds want to bet on the yen, you need somebody else that's willing to take the other side. And oftentimes that's the hedgers. And in this case, it's the corporates, it's the real money investors that want to hedge. That's a quick overview on FX market.
Yeah, no, it's so interesting. And I think what we'll do is we'll circle back to a little bit of a survey of the price of risk. Maybe it's FX vol. We'll spin around the asset classes and get your take on where there's value, what you think these prices tell us about the state of the world. You did allude to this idea that FX is in some ways driven by monetary policy divergence. And so I wanted to maybe start with the US side and talk about monetary policy, the state of where you think the Fed is going. And then also, I think increasingly a part of the US risk conversation is this big bad asset class called the risk-free one in treasuries. And there's definitely, at least a lot of my conversations increasingly start with the debt and the size of these auctions and so forth. And it's not to be a alarmist. It's just to say that this has become much more of a topic of conversation than it was pre-pandemic, let's say. But why don't we start with just the US setup on growth and inflation, how you incorporate that into your process of evaluating where you see opportunity?
If you think about it, the Fed funds and SOFR now, is really the pricing function for all assets. If you tell me where 3 months SOFR is going to be in 2 years' time, I can probably make a good guess on various assets are going to be based on that. I think first on the macro picture on growth and inflation, think about on the growth side, the thing that surprised a lot of people is that we've been very resilient, for a lack of a better word. We've been very surprised at the strength. And it's got to do with three unusual conditions in my mind. The first one is the household sector and the corporate sector is in a great place. They basically, if you take the average US corporate, I'm talking about the high quality companies, the IG companies, they've all termed out a lot of their debt, and their cash balances are, for some of them, high. And so they're earning a lot of interest income. And so historically, when you had this sort of tightening, the corporates would have felt it immediately because the borrowing costs have gone up, and that hasn't happened. And the same thing with the household sector. We have a very beautiful hedging instrument in our economy, which is the 30-year fixed mortgage. And most people have 30-year fixed mortgages. So which means that the interest rates going up at the margin makes a difference. But for many households, if they've kind of got a 30-year fixed mortgage, they're getting more income on the deposits they have. And then on the liability side, they've termed it up. So we've taken all of this duration risk from the corporate sector and the household sector, and we put it on the government balance sheet, which is what we did after COVID. That is a massive difference compared to previous cycles. The starting position for households and the corporate sector is very different. So that's why we haven't seen much of an effect from this tightening. Now, I'll get to this in a minute. The tightening, it's not like gravity. Tightening eventually catches up. So eventually when the corporates have to roll over the debt, which is, in my estimate, $7 trillion of debt that needs to get rolled over in the next 5 years, we're going to have some impact from that because the average interest burden is going to increase by about a couple hundred basis points. And that's going to come out of profits. Imagine you're going to have to pay 200 basis points more on 7 trillion. Okay, now your profits are going to go down by that much. So clearly there's going to be an impact when this debt gets rolled over. It's just there's a lag effect in that.
Let me just jump in on that, Kris. And I think that's really fascinating to sort of think about the positioning of the household and corporate sector going into this and the impact of rising rates. And as you said, some people effectively have the government upside down, a rare case where you're lending to JP Morgan at a higher rate than you borrowed from it. Really rare. Are you in the camp that higher rates are actually stimulative, or are you more in the camp that they're just not, the beta of the economy in terms of absorbing higher rates is just much less than it otherwise would be? How do you think through it?
It's a great question. There's no straightforward, simple answer to it. And I wish I could just tell you yes or no to that. So I would say that on the second point you made, the beta is more to longer duration assets. If you think about the US, we are the ultimate long duration economy. Look at the S&P 500. Look at the companies. 40% of the index is tech companies, which are all long duration. You think about tech's a long duration asset. So the whole entire economy is a long duration economy. We have 30-year mortgages. Our corporates can borrow money long term. We have corporates issuing 20-year bonds. It doesn't happen elsewhere. Most of the emerging markets and other smaller economies, you go to Canada, you get an arm and rate gets changed quickly. Like I have a friend of mine, she bought a house in 2020 and her mortgage reset. Now her interest payments are double what she was paying before. And thankfully she can still afford it, but it's a real tightening. Whereas here, it's different because the sensitivity is more to the longer duration. So it's more to what happens to the 30-year part of the curve and the 20-year part of the curve and 10-plus year part of the curve, and less to what the Fed does. So if the Fed hikes another 50 basis points, obviously people will be upset and all that. But is it going to really tighten as much? I don't think so. And the same thing, if the Fed cut 100 basis points, yeah, at the margin, it will have some impact because a lot of lending, credit card lending, stuff like that are linked to the prime rate, and that will have a follow through. But it's not at the margin going to make a big difference. But let's say the 30-year bond goes to 7%. I can tell you that most assets people own are going to be substantially lower because you got to discount all your cash flows at a much higher rate. And all these long duration assets, which is venture, real estate, tech, all of this stuff is fairly long duration assets. You would have to basically reconcile that. So the other thing I was going to mention, on this was, so the first one is the starting point on the household sector, right? So they're starting at a very favorable place. The second thing is that if you look at fiscal policy, we've never had such loose fiscal policy with the unemployment rate at the cycle lows. So historically, if you look at it, we spend money in a recession. Our fiscal deficits go up when we are in a recession. But this time around, we have very low unemployment rate and fiscal policy is extremely low. The last one is that if you think about even the inflation side, we had inflation averaging 5% a year ago. Inflation is definitely coming down dramatically without having any real impact on the economy. So if you think about jobs or any of this sort of stuff, we haven't really had much weakness in the labor market just yet. We haven't had any big issues come up besides the banking stress we had last year. So I think overall, the Fed's done a pretty good job in landing this thing. Now, obviously, they can always make mistakes. They could overestimate how strong the economy is now, underestimate how much easing they have to do. I don't think they have any good forecasting tools and all this stuff, and they're going to have to make the rules up as they go along. But I do think that up to this point, if you look at what the Fed's done, they've hiked 500 basis points and nothing's really broken besides the banking system, which obviously is a separate topic. I think they've done a good job overall.
Well, let me ask you this. If you think about the stance of Fed policy versus fiscal policy today, it seems in some ways inverted versus, let's say, 2011, especially post the John Boehner, Barack Obama showdown with the first debt ceiling. There was, at least from the U.S.'s standpoint, relative belt tightening in that period afterwards. But of course, the monetary policy promises were almost ad infinitum. You kind of forget about these things, but I remember looking at some prices in 2013 and 14. As I reviewed them, I could not believe how much that forward guidance was implanted into the yield curve. Bernanke was telling us that we were staying at zero. And of course, if it's the Fed's saying that, the market's going to generally believe it. My question is the Fed just much more operative on the price of risk, whether it's vol or the shape of the yield curve, maybe the valuation backdrop versus its impact on the real economy? How do you separate the ways in which the Fed's deeds and actions and words ultimately have impact?
If I were to reframe your question, I think one could argue that they've gone way beyond a central bank would historically have done. The central bank that's just focused on inflation. Now the Fed's taken on other mandates. So obviously that's happened over time. But it's also a much more complex economy. We don't have a simple economy where you have one policy lever that you pull and then the entire economy responds to that. So you almost need other tools. But I want to say two things on this. One is that if you think about the stuff that the Fed did in 2008 and the stuff they did in 2020, 2020 was amazing. They went and bought ABS and they were backstop for corporate bonds and they did all this amazing stuff to make sure the world didn't come to an end. But you could argue, should the Fed actually be involved in these markets and should that be the role of the Fed? I don't know. I think that in my mind, what we need is a lender of last resort, somebody that can show up when there is panic. So when Silicon Valley Bank happened, what the Fed did was amazing. They showed up and in a weekend, everything was done. I think that's probably more of the role of the Fed. The second thing I want to say is that you alluded to this, which is the nature of coordination in monetary and fiscal has changed. So if you go back in time, the central bank independence thing is a new thing for most countries. except the ECB, which is like created by a treaty. Most other central banks used to be part of the government. In the last 20 years, we started to say, oh, central banks are independent, they're going to do what they want to do type thing. But now that illusion is gone. So you take Japan, the BOJ has to coordinate with the MOF in some fashion. They can't do opposite things. You take the US, to a smaller extent, like the quarterly refunding announcement, have to be done in the context of how much QT the Fed is doing. You can't just have Yellen doing one thing and Powell doing something different. So there has to be much more coordination. Now, the issue is, if you look at the UK, the Bank of England used to be part of the government. So the Bank of England governor used to be part of the government. The Bank of England as an independent institution is a new thing. And the Fed, it is an independent institution and has a lot of credibility because you just look at the shape of the yield curve. The yield curve is inverted because the market is saying that the Fed's done a great job and inflation in the future is going to be a lot lower. That's how I read the yield curve today. If you think about what this coordination means, it means that historically you had this incoherence where in Europe, the ECB was cutting interest rates into the Greek financial crisis. And then you had Schäuble and all these people in Europe saying, oh my God, we have to have austerity. We don't have budgets. We don't have money to spend. And so there was this sort of constant conflict between the central bank and the fiscal authorities, where one of them was trying to go left and the other was trying to go right. And net, the outcome was bad. So we ended up in secular stagnation, as Larry Summers calls it. We ended up in this sort of very low inflation environment with very low growth because of this lack of coordination. What we've seen since March of 2020 is a lot more coordination where central banks and fiscal authorities work together. And what they've shown is when they work together, we can generate whatever inflation we want. We want to generate 10% inflation. We can generate 10% inflation. That's not that hard. And if they now achieve this beautiful landing where they bring inflation down and growth kind of moderates, then you would sort of say this is actually working. Like they managed to do that. Now, I do think that we're at the stage where some of the tightening will start to be seen in the economy. Just some of the data we track, credit card delinquency rates, even if you just think about some of the debt that needs to be rolled over in the next year or so, in high yield and other markets, you kind of see like a lot of tightening coming through. So there is this idea of this Wixelian rate, right? Wixelian rate is this rate at which people are lending and borrowing money in the economy, in the real economy, not what the Fed funds rate is or what you can get at the Fed discount window. And that this Wixelian rate is high and it might go a lot higher. So there is this tightening that's coming through. But to come back to what you were saying, I think the whole coordination part is what has changed. So there is a lot more discussion when the BOJ decides to do something. It needs to discuss with the MOF what it means to GDP yields. BOJ cannot decide on its own, oh, we're just going to get rid of our QE program. It's just not possible. That's actually not a bad thing, the coordination, but it also means that there is potential for inflationary episodes like we had. Fiscal authorities, governments like to spend money. So you might get whatever the next administration is, whether President Biden gets reelected or it's Trump or it's RFK Jr. We don't know who's going to be the next president, but whoever comes in, there is this tendency to want to spend more money. So that becomes a problem when you have the monetary authorities working with the fiscal authorities, because there is then this sort of potential for higher realized inflation. I also think from an inflation perspective, what happens next depends more on fiscal than on the monetary side.
That's where I wanted to take it, which is maybe goes back 10 or so years. But one of the themes in markets we would hear a lot of was a shortage of high quality risk-free assets. And I think it's a little harder to make that argument that there's a shortage of these things. There's more than you could ever imagine coming. These refunding announcements are big and getting bigger. As you mentioned, there's this disconnect between full employment and 7% budget deficit. Those are substantial. And so where I wanted to go, Kris, was just around your broad view on how you'd characterize valuations. Let's maybe start with US and you can expand it to global assets. Fixed income is in some ways the starting point. That's the risk-free starting point. Equities move around for a lot of reasons. They're certainly not completely tied in any way to the rate backdrop. We have these valuation bubbles and so forth that occasionally pop up. But a 5% rate today is much different than we've experienced before the pandemic. And so it, in some ways, makes its way into the conversation around equity valuations. Give us the setup. When you step back and you look at the broad environment for valuation across the major asset classes, and you've talked a lot about fixed income, but maybe bring in equities and commodities as well.
Let's start with fixed income because we always like to think about that and then from there get to other assets as well. In fixed income, we're in a much better place now globally than we were 4 years ago. So if you think about 2-year notes, if you buy 2-year notes, for you to lose money over the next 2 years, interest rates would have to go up 400 basis points or more. So you have over a 2-year horizon, very good chance you get a positive return today compared to say 2021 when I think 2-year notes got 10 basis points. So you got like this nice yield buffer. So we'd like to think about everything in scenarios. So in the base case scenario, let's say inflation does come down, but it doesn't come down as much as it has in the past because I think there's kind of a floor on inflation given the deficits, and I'll come to why in a minute, but there is sort of like instead of a ceiling of 2%, it's almost like a floor of 2%. Inflation comes down, but not as much as people would like. In that scenario, maybe 10-year yield should be closer to 3.5%, 3.5%, because maybe the SOFR is going to be at 3%, 2.5%, 3% end of the easing cycle. And so we should have 10-year yields maybe at 3.5. That's kind of a way to think about it. But the real interesting thing is you're getting a real return in fixed income, not just here, but elsewhere too. So here we went from negative 2% real rates to positive 2%. In Europe, we went from negative 1.5% to positive 0.5%. And in UK, we went from negative 2 to positive 1. And in places like Brazil and Mexico, you have positive 5% or higher. So you have real positive returns on top of inflation in most of the world in terms of fixed income. So that's a very attractive starting point. So now if you then move to equities, some of the things that we like to look at in terms of understanding valuations, as you know, like valuations work in the very long term. In the short term, you can't use valuations to decide on trading or something. If you think about valuations from an earnings yield perspective, U.S. equities at the moment have zero earnings yield on top of what you're getting in fixed income. So if you look at equity earnings yield minus bond yield, it's close to zero. And if you go into other markets, it's similar. You have some positive earnings yield in Japan. You have a very high earnings yield in places like China. China's got a 6% equity risk premium, if you look at the earnings yield minus where Chinese government bonds are. So there are parts of the world where you're getting paid. With the US, the equity market is trading more like bonds because it's not giving you anything on top of bonds. And you have to ask the question, why? And I think it's got to do with two reasons. One is that the composition of the index obviously is a lot of technology companies in the S&P 500. 30% is tech plus Amazon and Apple and some of these other companies. You add them up, you have a lot of the index made of tech and tech-related companies. For some reason, the market thinks that tech cash flows are very obvious and clear and there's not much earnings volatility on these large cap tech companies. So it kind of puts this higher multiple on it. So the S&P is trading currently around 21.5 times, depending on what you think forward earnings are, in 21.5 and 22 times, which is on the expensive side. So average S&P multiple going back in time is probably 14.5, 15. So it's definitely on the higher end of it. And then if you look at from a earnings perspective, the S&P companies made about $216 last year. Next year, earnings is supposed to grow like 10+%. So call it 235 to 40. is what's penciled in. I mean, I think Bloomberg had 238 in terms of expectations. But imagine all of that earnings is coming from like four companies. So if you take those four companies out of the index, Q1 earnings are actually down in the S&P 500. So you basically have an index which is basically a bet on those few companies. And those companies essentially are a bet on generative AI and this whole productivity boom we're likely to get from that. That's what the market is doing. Now, the problem with that is imagine these companies don't actually grow earnings 10% or 14% or whatever is penciled in for S&P 500. And let's say the earnings are flat. Then the market's going to be very quick to derate, because what happens is with the market is when the earnings are growing, it kind of re-rates the market and multiples go up and multiples expand. And then on the way down, it derates. You could easily see S&P multiples at 18.5, 19 times or 18 times even. And then you got like a flat earnings growth. And now suddenly you're at 4,000 on the S&P 500. So there is a lot of downside in the index at the index level. Now, I'm not saying there are some great companies within the index. Those things can go up fivefold. So that's not what we're talking about. We're talking the index level looks very expensive at the moment. And we could end up with meaningful repricing in these markets.
I was just going to say what's super interesting is the S&P as a benchmark, and there's trillions and trillions. I'm going to say maybe 7 or so. It's probably more like 9 that's very explicitly, literally passively tied to the S&P. And then, of course, the untold tens of trillions that are just a nudge away from passive. If you ran the correlation of the portfolio to the S&P, it's 80 to 90%. And it's a beast of a benchmark. It's an incredible realized Sharpe ratio. It's as liquid as could be. It's in broad daylight. I kind of contrast that to some of the IG fixed income benchmarks. Again, I go back a couple of years, not now, but go back to that post-crisis, pre-COVID period, or even in 2021 when rates were super low and credit spreads were super tight. Not that hard to beat that benchmark. I think part of the challenge, for investors, Kris, is that the S&P, its performance is so unbelievably strong and consistent. And I don't know if that itself becomes a risk. It's so hard not to be long that Magnificent Seven, right? The career risk of underperformance becomes an issue.
Yes and no. So I agree with you. There is definitely this effect, which is if you had a Warren Buffett portfolio for the last 30 years, you did well, which is 90% of the portfolio was in US equities, S&P 500, and you had a little bit of cash just for the rainy day. You did pretty well doing that. But we have to remember why this happened. This happened because we had these amazing companies which were able to not just grow top line, but also their margins expanded dramatically. So if you take the FANG stocks and maybe NVIDIA and their margin expansion out of the S&P looks like a pedestrian index. It looks like the Euro Stoxx 50. It doesn't look that different. So all of this amazing performance and Sharpe ratio that you allude to has come because we've had these companies that were able to generate this sort of return and also to expand margins dramatically. Now, if you think about margins are kind of mean reverting over time, but they may not mean revert in the short term. And a lot of people have gotten it wrong, betting on very sort of a shorter time scale reversion in this. But over time, when margins expand, there is obviously somebody else that's not getting paid. Take the US economy and look at the macro profits as a whole. So you have the household sector, which is getting wages. You have the corporate sector, and you have the credit people who are charging a spread on top. And then you have the government, which is taxing the corporate sector. So the corporate sector profits is a function of how much they're paying in wages, how much are they paying in taxes, and how much credit spreads they're paying, which is actually just spread on top of overall base level of yield. So if you take the corporate sector and you play this forward 2-3 years out, clearly the base level of interest rates that they will pay on average is going to be up if rates are going to be around here, because it's at least 250 basis points spread to where they borrowed money to where interest rates are right now. So that's just the base level of rates. Now you look at spreads, whether it's high yield or IG, whichever favorite part of the credit markets you look at, spreads are quite tight. So if you think about a scenario where the government's spending lots of money and all of that debt has to be somehow, somebody has to buy it, and you got this issue with the corporate sector also showing up with 7 trillion of refinancing in the next 5-6 years. So if inflation doesn't come down, then the amount of interest they would pay will be substantially higher, and maybe credit spreads also will widen out. So that could be negative. So the base level of rates could be higher and also the spread. So that will detract on profits. The taxes, one could argue, is already quite low. And if anything, maybe we will try to get more of those profits. And so taxes could go up potentially. And then on the wages side, clearly what we've seen is that real incomes haven't gone up as much. We've had a big inflation, but that's gone to the lowest income earners. So if you think about the overall economy, they have a higher propensity to consume and spend money. And that's why we've had this sort of wages causing a bit of inflation. But the overall, if you look at real incomes over time, it hasn't really accelerated. And so if you have a tight labor market and this thing continues for a while, they would have to pay more of that profit as well to retain employees. So you could kind of see where this big margin they have could get taken away. And that's where the scenario that you outlined could happen, where the US actually underperforms. The other scenario I can see is that if you think about what we did over the last 20 years, we basically invested a lot of money in bits. So we wanted to take AI, take cloud computing, take any sort of software related things. We are really good at that. So most of our largest companies in our S&P 500 are tech companies. So we invested a lot in bits, but we haven't invested as much in atoms. What that means is if now we have to pivot away from bits towards atoms, we need to invest in companies that are involved in that. So we need to be buying energy companies. We need to be buying industrial companies. The tech companies are already at a very high multiple. And if anything, investment flows have to go away from them towards some of these other places. Just to give you an example, let's take the outline where you imagine all of them, if you take all of them at face value in terms of how much energy demand they're going to have. So they're expecting about 1,000 terawatt hour of incremental energy demand over the next 3 to 4 years. And our grid capacity, our total generation capacity, I think is about 4,000 terawatt hour at this point. So it's about a 25% increase in energy demand just from AI and data centers in the next 3-4 years. How are we ever going to be able to meet that demand? How are we going to ever do that? We would have to do every possible forms of energy. We would have to invest in nuclear, solar, every possible renewable source of energy. And even then, we may not be able to meet that demand. If you think from a bigger picture, just stand back and look at the index, you're basically betting on tech when you're long the S&P 500, because that's what the index is. All the profits are coming from tech. 40% of the index is actually tech companies. So if you're buying an index and you're saying, oh, look, I have 500 stocks, I have news for you. No, you don't. You have 7 or 8 stocks at best.
If you look at the performance of the S&P last year, it was 26%. There's the RSP, which is just the equally weighted version of the S&P. It was up half that. And I think what you're suggesting is, at least potentially over a forward-looking time frame, there's scope for a reversal of that, where some of the more industrial, energy-centric companies take up some of the slack. And maybe it's just because the price is already reflecting so much optimism for tech, even though they're great companies and doing amazing things, that the price got there first. And so the forward return outlook is just not as favorable. Is that kind of where you're going?
I would also add on what you just said. If you take something like Microsoft's a great company. Their Market cap is, say, roughly 3 trillion. The entire energy sector, you take all the companies in the energy sector, the market cap is probably half of that. It's probably 1.5 trillion. And then you take the free cash flow that Microsoft generates in order to do the buybacks and dividends and all the other stuff, all the investments they're making in OpenAI and other companies, it's 60, 70 billion, the whole of Microsoft. Now, energy sector as a whole generates double that. So energy sector, I think, generates about 140 billion free cash flow. So at some point, if interest rates stay high, people are going to say, where is the cash flow? I want to see the cash flow. And if you notice some of these tech companies are starting to pay dividends because it's partly this question from investors. Hey, you're generating all this cash flow. That's great. But we don't want you to invest it in some pie in the sky projects that are not necessarily going to contribute any value to the company. Take AI. Roughly speaking, right, that 7 or 8 companies are investing about 400 billion in AI related things. So that's data centers, GPUs, you name it. They're investing in all of that stuff. Now, what if all of that investment doesn't bear fruit in the next year or two? You take most of the studies from McKinsey and Goldman Sachs and all these smart people, they've come out with estimates of how much all this AI is going to add. And it's roughly about 2% productivity growth over the next 3 years. So it's not now, it's in 3 years' time, maybe, you get some productivity growth. But what if it's not 3 years? What if it's 5 years from now? And what if at some point in the next 3, 4, 5 years, people turn around and say, this all sounds good, but where is the cash? I need to see some cash flow because you can't keep up 400 billion of spending for a long time. You could do that this year, maybe you can do it the next year. But if rates stay up here, there's going to be a big question mark around what is it that is result of all of this. Now, we use AI in our work a lot, like we use it to read every research we receive, and we do it all kinds of reasoning problems with it, and it's great. It's amazing technology. But at the same time, I'm not sure that the AI monetization is going to be similar to how other technologies have been monetized. So for instance, I use OpenAI, the API, to do all my inferences. But what if I get a GPU and I can run Llama 3, which is a free open source model from Meta, in my office closet, and suddenly now I don't need OpenAI. Not only that, this is not going to cost me a whole lot of money over time. If I can do that, I'm a small firm in New Jersey. Imagine the large firms. I mean, they can all do their own inferences and they can even build their own models in-house. So you don't really need the large companies to provide the services. So I think there's the issue of whether this becomes like an operating system. You remember when the Unix operating system was on, there was all these companies selling Unix. So Sun Microsystems and all these other companies. But then later on, Linux came about, and then all those companies kind of disappeared because everybody said, oh, open source, free, I'm going to use Linux. And that could happen here, where the best models over time are actually the open source models. So these companies don't actually end up being the big winners. And then the other issue I have is the whole thing with GPUs, which is that GPUs seem to be a very inefficient way of doing the computation because they are extremely energy intensive and you need all these cooling systems and fairly complex things to cool this thing down. And maybe there is simpler things that are going to come about. So there's stuff around silicon photonics. There is potentially some ASIC or some other solution, some other chip formulation is going to show up. And then people are going to say, we're not going to use GPUs because it's too expensive energy-wise. And if that happens, all this CapEx will have to depreciate quite dramatically. There are a lot of risks to the market because the way the S&P 500 is constructed, historically, it benefited from large cap companies being the dominant players in the market and those companies having these massive margin expansion. Now, on the reverse, imagine a scenario where the earnings growth isn't great and we all decide together that what we need really is energy, not so much AI, because without energy, we can't have AI. And so we all pivot that way. Then I think we could have a substantial repricing in the equity market. So obviously other parts of the index will go up, but as the index as a whole may not do as well.
Last week when we touched base, we talked about the theme of decarbonization, which is something you've been thinking a lot about. You've made the comment to me that there's pretty significant implications for inflation. You've talked a lot about India in terms of the introduction of air conditioning and, of course, climate change and the impact there. Take us through your thought process of this sort of longer term thematic thinking on a perhaps slow moving, but a powerful trend and theme that you think is ultimately going to have a lot of implications for how assets are priced and maybe how commodities are priced as well.
Yeah, I think decarbonization is a very big topic, and we could do a part two on that. I'd like to highlight three things that I think are important on this. The first one is that obviously, if you think about this whole idea of not using fossil fuels and using renewable energy and we doing everything from our grid to the cars we drive to our cooking stoves and all this sort of stuff. I mean, it takes a lot of investments to do that. So you need like a lot of capital. If you're going to be redoing all this stuff, you're going to suck a lot of capital from elsewhere. So if you imagine like we decide, okay, we need to have all these solar farms and we're going to have all this nuclear energy. So we're going to build like small modular reactors or large reactors, whatever the reactors might be, all of that stuff is going to need a lot of capital. So the real interest rate has to go up if we're going to do this. And part of this is, I think there's two reasons why we're doing this. One is obviously from a climate perspective, it could be argued that changing our energy mix might be good, but we could also argue that it makes us more self-sufficient. We are already the largest producer of crude oil. And imagine if we were able to do all these renewables here, we would be a very energy-rich country and we can attract all kinds of manufacturing back to us. So that's, I think, part of the second thing. And then the third reason, of course, is geopolitical reason, which is, do you really want to depend on other people being nice to you in order for you to go about your life? So I think we've kind of realized in the last few years that maybe having this sort of global supply chain and stuff, not such a good idea, and maybe we should keep things closer to home. And so you see Mexico has had a big manufacturing renaissance, and Mexican peso's done well, and equities there have done well as well. On the decarbonization side, I think the first thing in my mind is that it means a higher real interest rate because you're going to suck a bunch of capital into that, and that is going to mean interest rates would have to go up a little bit. The second thing is that we want to be very competitive in terms of energy. If our energy costs are $50 a megawatt hour and China's cost is $15 a megawatt hour, it's a big deal. Because if somebody can generate power at a much lower cost, then they're going to be able to outcompete us in all sorts of industries. So part of the problem we're having now is China's done massive amounts of investments in all these things. Just in energy, just to give you an example, they've actually installed more solar last year than the entire installation in India. So you take all of India's solar installation, I mean, they've done more than that. The same thing with all the other things. They have more nuclear power plants that's going to come live. They basically made themselves very resilient from any external shock by investing in all this stuff. And of course, like you could argue that that creates a lot of excess capacity. Now they can turn around and dump that capacity on the rest of the world. So everybody's worried. So Yellen has been there and other countries are complaining to them as well. Obviously, if you've driven one of their EV cars, I drove a BYD in Mexico. It's a nice car. It wasn't inferior in any way. You could see how something like that could be a huge winner in emerging markets. Could be a very inexpensive electric car, very cheap to maintain. So that creates a problem for the rest of the world. So we have a lot of EV companies here, amazing companies, but then if cost-wise, if we're not able to compete with them, that's going to be a problem. And I think it comes down to having a very low cost of energy production and having the grid to do it. So that's why I think The second point on the decarbonization thing is it's a national security issue, but also a competitiveness issue for us. We need to be able to compete with the rest of the world, bring all this manufacturing here, and we need very cheap source of energy. Of course, we have gas and we have all the oil we would want, but it's nice to have solar and some of these other forms of energy because that makes us more resilient. So I don't think we want to bet on one form of energy or the other because we just don't know. I'll give you an example on solar. There was a story where in India they had a solar farm. It was an offshore solar farm. And then they had a storm and the whole solar farm got destroyed. So imagine we went and did all our solar installations in the Midwest and we had some tornadoes come through and take all the panels out. It would be a big problem for us. So we need to have that, but we also need to have some other sources of energy, I think. So that's the second aspect of this whole decarbonization thing.
So interesting. And we've become accustomed, maybe it's more of a societal thing, but we're so instantaneously focused. This is perhaps reflected in our industry in the zero DTE option craze, of which, by the way, I've learned that the option volume in India far surpasses that in the US and in any other country in the world at this point. I had not known that. There's a very short attention span for folks these days. And so to think about these longer term themes, I think a couple things. One is you really got to have, and I'll borrow from Seth Klarman here, the patient investor. There's so much focus on the day-to-day P&L, which of course is a reality you have to tend to, but sometimes I think it pulls people away from being able to really think through longer term themes that'll play out, but it'll take some time. Here's where I wanted to close. We started with FX derivatives, and you've got a background in macro and also just a keen understanding of structure and things like convexity and the price of vol. As you sort of look at the prices across the asset classes and across vol surfaces, as they say, anything stand out to you as especially interesting, actionable, head scratcher type of prices where you're trying to understand why a price is clearing at the level it is, either on the high side or the low side? What looks real interesting to you right now?
I think there's a couple of things on the vol front. If you look across the various asset classes, index, equity indices, interest rates, commodities, currencies, pretty much across the board, volatility is lower or towards the lower end of the spectrum, except in interest rates. In interest rates, you have pockets where rate vol is actually on the higher end, but the rest of them, like in equities and even in currencies in particular, vols come down a lot because the central banks are not active. The Fed's talking, the ECB's talking, BOJ did something, but they're still just getting off from their chair. So there's a long way for them to go. So when those central banks start to do things, that's when currency vol gets going. In equities, volatility is pretty low, but as you know, it's because where implied correlations are. So we have this weird market, and it goes back to what we were talking about before. We had 4 or 5 stocks driving the market in terms of earnings growth, and then the small caps haven't done so well. So if you take the S&P 500, it's a tale of two markets. The small caps have struggled a little bit, and then the tech related, I wouldn't call them tech because there's some hardware companies and some industrial companies that have also done well. So that stuff's done really well. So there's a lot of dispersion. So because of the dispersion, we have very low implied correlation, and that's driven index fall down. So now if you get an unwind of that, and how does it happen? It could happen because people agree with me and say, oh, this AI stuff is going to take longer to happen. AI might be much bigger than we think, but it could take a lot longer. And in the short term, nothing really much comes out of it. So that could be a scenario where implied correlations would go up and dispersion comes down, and you get the whole fall move potentially in equities. In rates, I think it's got to do with the Fed, because clearly it's hard for the Fed to lay out where they're going to be a year from now or even 6 months from now, because there is still a bit of inflation that they want to get over. So I think the moment we get a couple of softer inflation prints, maybe starting this month, maybe then interest rate volatility comes down a little bit. So that would be the catalyst for that vol to reset lower. And then, of course, in credit, as you know, default rates are low. They're starting to go up. Depending on where you're looking in credit, of course, credit card delinquency rates are going up. But at the index credit CDX level, as you go through the cycle and there's more tightening, you could clearly see more defaults next year. And as you go into that, credit spreads will widen, and then, obviously, vol kind of is correlated to spread moves. You could see that credit vol will pick up later this year. Commodity volatility overall is lower, and that's only because we've been anchored by this period of extreme price action due to what happened in Russia, what happened in the Middle East. That's caused us to be open to the idea of crude oil going to $150 and other commodities going up. But overall, if you look at it, commodity volatility looks cheap to us because a lot of things can happen, particularly if you're going to do all this AI spend. You're going to need a lot of commodities, not just energy. You're going to need copper. You're going to need other things, graphite and lots of other things. So we're going to need more commodities. And I think there's more appreciation now that the supply-driven inflation is not so great. If you go back in time and look at the last 3-4 years, some of the inflation we got was really supply-driven. Some of it was demand-driven, but a lot of it might have been supply-driven. And if we had a better handle on commodities overall using other PR type things, but for other commodities, maybe we won't get that sort of chance. So I think commodity volatility could again rear up this year. So that's something we're more inclined to think there is potential for volatility there.
It's an interesting setup. I think none of these option prices are really outside the boundaries of what their realized vols justify. S&P is realizing, depending on your day, 12 to 14. You referenced copper on the lowish end of implied, but also not really justified to be much higher based on realized. And I'd say the same with crude. So it's a very interesting setup and probably doesn't really incorporate any of the forward-looking, longer-term horizon actions that you're highlighting here. So it's quite interesting to look at. Well, Kris, this has been a great conversation. I have truly enjoyed learning from you and getting a chance to listen to what's on your mind and your framework. And I'm really glad we have an opportunity to do this. So thank you very much.
Thanks, Dean. Thanks for having us.
You've been listening to the Alpha Exchange. If you've enjoyed the show, please do tell a friend. And before we leave, I wanted to invite you to drop us some feedback. As we aim to utilize these conversations to contribute to the investment community's understanding of risk, your input is valuable and provides direction on where we should focus. Please email us at feedback@alphaexchangepodcast.com. Thanks again, and catch you next time.